Welcome back. Well, in a week's time, Finance Minister Enoch Godongwana will take to the podium to deliver the medium-term budget policy statement, which will give us an update on growth, inflation expectations and government spending priorities. In the lead up to that, Bank of America has put out a note detailing its view of the South African economy. And I'm joined now by the firm's Sub-Saharan Africa economist, Tatonga Rusike. Tatonga, thanks so much for your time today. So the latest report that you put out suggests that South Africa's fiscal position is improving faster than we had expected. How confident are you that it's sustainable, though, given that we are facing a rather weak economic environment?
So the question of sustainability is a very good one. But before we go there, let's start with saying, compared to where we've come from, we started the year with a lot of budget debates, with a potential VAT increase that got rejected and the budget eventually being passed. And if you can see the in-year performance, particularly on the revenue side, it's ahead of expectations, SARS confirmed. And you can also see on the spending side that it's still slower than what was planned. So already with the 6 months of data, we are looking at a good performance. Whether they can keep that going is probably the key question. But I think the signs are there that over the last 2 years, it is Treasury's intention to try and maintain a good spending grip, so that deficits come down and debt can stabilize. So that is one of the big objectives of the Treasury. So midterm budget is an opportunity for them to underscore the direction that we can say indeed it's going to be sustainable.
You are forecasting a main budget deficit of 4.3% of GDP. That is slightly lower than the 4.6% that Treasury itself is currently estimating. And you note that a smaller budget deficit could reduce government borrowings by about 30 billion rand, the needs at least. How significant would that be in easing debt pressures that we are facing, and more so to that, increasing investor confidence?
Yeah, I think it's very important in the sense that you've not seen this level of the budget deficit in many years. You could probably go back to pre-pandemic, maybe far back to 2018, when you see this kind of deficit. So it's very important for investor confidence to signal that indeed the deficits are coming lower. And it is also a combination of other factors that have helped Treasury get some of the revenues that you are seeing now. We are in a better place where gold prices are higher, PGM prices are higher, so South Africa is benefiting from better terms of trade. Corporate taxes also have benefited from this environment. So the central bank has also moved to a lower inflation target, which has helped to move interest rates down, yields down. So all of these combinations help with positive investor sentiment, which is what we're saying.
Do we also put it down to lasting structural reforms at SARS, perhaps? Because, you know, seeing commodity prices go up and the wins we get from that from a revenue collection perspective are kind of short-term gains until that cycle turns. So one then wants to ask, you know, is it structural changes at SARS that we are seeing coming through that could give to that sustainability that we're so desperately hoping for?
I think it's one of the key factors. We've seen SARS reforms, I think, over the last 5 years or 7 years, you could say, since pre-pandemic, and they have strengthened quite a lot in terms of administrative processes. So there is an element of collection, but there's also an element that the economic outlook has improved. You can see in the second quarter, economic performance was much stronger than expected, and this reflects also in the tax revenues that SARS collects. So there is a tailwind with positive terms of trade. There are administrative gains that SARS has made with all the reforms. And also on the other side of the equation is spending grip. We've seen lots of pressures from state-owned enterprises, Eskom, Transnet, looking for further bailouts. But I think Treasury has focused on more reforms of the institutions rather than continued state bailout. So that helps on the spending side. So at the end of the day, the deficit becomes smaller than perhaps what expectations were.
Tatonga, your report also points to the possibility of a credit ratings upgrade for South Africa. But what would ratings agencies really need to see in the MTBPS and more broadly than that, even from government and reforms to make sure that that upgrade definitely does come through?
Yeah, I think there are two things. Number one is growth. They want to see GDP growth that is higher than current levels. So we are expecting growth around 1.2% for this year. That rises to about 1.4% next year. Rating agencies would like to see growth at least 1.5% and higher. So as far as growth is concerned, we are not yet there. But signals that suggest that growth in 2027 and above is going to be closer to 2%. There are logistics reforms taking place, so that's supportive. What we are saying is, I think in the near term, you've seen fiscal improvements, and that should be a good catalyst near term to suggest that the direction of travel is actually positive. If these fiscal improvements are sustained into 2026 budget, you will get large enough primary surpluses that can stabilize debt and start to bring it on a downward trajectory while GDP growth improves more materially over the medium term. So fiscal is probably the first catalyst in the near term. Then secondly, growth over the medium term can help them nudge in the right way.
Speaking to that growth picture, is the idea or the move or the plan really to anchor inflation at 3%. Currently, the official word from Treasury is that we want it anchored at 4.5%. Do you see that adjusting that anchor target down for inflation as positive? Is that really going to factor into some of these growth projections that we're hoping to achieve in the midterm?
Yeah, I mean, from a market's perspective, markets have already factored in the move to 3%. Markets like it. You have seen adjustments in domestic bond yields. 10-year bond yield is now less than 9% compared to over 10.5% it was at the beginning of the year. You can use CDS, you can use other measures. But markets have responded positively to the announcement since the announcement was made back in July. Now I think for the Treasury and particularly for the Finance Minister, the market is looking whether he can give more clues in terms of agreeing or giving the nod to proceed with an official target change. So yes, you can get some short-term pressures perhaps on reduction of the extent of revenue gains, but growth, you have got some positive tailwinds that have come through that might reduce the potential negatives of slower growth with a lower inflation target because nominal growth becomes lower and all of that. But I think there are enough tailwinds that support that ultimately you will get lower interest rates. So we are forecasting more rate cuts into 2026, which would support consumption and ultimately support growth.
Tatonga, thanks so much for those insights this evening. Let's leave it there. That was Tatonga Rusike, Sub-Saharan Africa economist for Bank of America.